Thank you very much for coming. As Tim mentioned, I'm Alex Scanlon. I'm the CEO of Barton Gold. And Barton Gold, for those of you who are not familiar, is a South Australian focused gold developer. So we like gold in Australia. It has a lot of the same dynamics in terms of market risk, infrastructure, access to good, skilled mining labor force as Canada, and a lot of those same benefits that you get in sort of built-in exchange rate hedge. We really like South Australia because it's actually very, very richly mineralized in terms of gold. It actually holds about 25% of Australia's known gold resources, but actually speaks for quite a small portion of annual production. And that's really a history or legacy of very heavy copper and uranium investment in South Australia. And that happens around that sort of the eastern margins of the legendary sort of Gawler Craton. So this is where BHP has Olympic Dam. Actually, to the west of that IOCG province, there is a historic 130-year-old high-grade producing gold district called the Central Gawler Gold Province. We have gone and consolidated pretty much every significant historical exploration and producing asset in that province. We've put together about a 5,000 square kilometer tenement package, or 1.25 million acres. On this, we have built a 1.3 million ounce resource base now. We've recently grown that. That is continuing to grow quite quickly. And we also own the only gold mill in the region. So we have a very strong sort of point of leverage in terms of infrastructure to our own ounces, but then also to all of these sort of explorers who are now rushing around us as we are sort of leading this story. So the key thing for us is we are a very focused platform. I'm not talking about nickel and iron ore and different jurisdictions. We are South Australia and gold. That gives us a number of advantages. And we are also very well capitalized. So we have about $13 million worth of gold in concentrates and cash. So we are in a position where we monetize our assets, and that's also quite unusual, as you know, in the sort of junior space. Looking at our capital structure, obviously we often hear that Australian companies have 4 or 5 or 7 or 8 or 12 billion shares on issue. We don't. We have 195 million shares on issue. Our market cap in Australian dollar terms is around 46 or 47 million, so call it 30 US. And on an enterprise value basis, we're worth about $25 million US, or in the low 30s from an Australian basis, particularly once you factor the four and some dollars worth of gold and concentrates that we have. Quite importantly, we are very strongly aligned in terms of board and management with the balance of shareholders. So board and management represent about 23% ownership of the company. We have also a number of specialist gold resource investors who've come in and joined us progressively over time, including most recently in June after our April resources update. And we're really starting to kind of break away from the market, if you will. We're dramatically outperforming all of our peers on a sort of a peer index basis, the gold price itself, and even some of our more illustrious peers in the VanEck producers indices. So we're starting to sort of get the story out there, which is why we're here. And of course, we're very accessible. So we're home exchange is ASX. We've now listed also on the OTCQB and the Frankfurt Exchange to accommodate a lot of our European investors. Key thing for us when we think about corporate capital is human capital. We have built a very experienced team. Just in our sort of senior leadership team, we've got well over 200 years of experience exploring for permitting, financing, developing, operating, and optimizing assets, with a very strong pedigree in South Australia and a very strong pedigree in gold. So those of you who remember the big news 20 years ago was when Newmont was buying Normandy. Now it's Newcrest. 20 years ago it was Normandy. Half of my senior team are former Normandy senior execs. We have the former general counsel of Santos Limited on our board, and we have mill specialists and development specialists built into the team. So this is really a platform that has been built for this big objective. And this big objective, having consolidated all of this, is to put together a quite meaningful producer. So we are targeting 150,000 ounces per annum of production. We are focused on large-scale, bulk, open-pittable mineralization. We like open pit because it's easier, faster, safer, cheaper to find, develop, and operate. And what we're really looking for here is actually the combination of our Tarula and Tunkillia assets. So these assets together, we have about 3,000 square kilometers of property. On that property, we have over 100 kilometers of major structures, several of which we're the first to identify. In there, we have over 1 million ounces grouped together already. And these are complementary assets too. Tarula is looking for shallow, sort of shallow, high-grade deposits, and Tunkillia is hosting large, bulk, open-pittable, shear-hosted mineralization. But we also have the advantage of our existing mill. So when we think about how we go and develop these things, dilution is one of these big questions, right? Permitting, construction cost, dilution. We have a project at Tarula that has previously mined and processed through our mill. So we have fully permitted mining leases, we have proven infrastructure, proven logistics, proven metallurgy. We are going to go through now and put together some high-grade resources at Tarula that we can put through that mill as a stage 1 operation, get cash flow going, and then treat Tunkillia as an expansion project. And Tunkillia is targeting the jump from, say, 30 or 40 or 50,000 ounces up to 150,000 ounces. And we like Tunkillia for that model, and we have these things specifically in that order, with Tunkillia as that sort of middle distance expansion style operation, because it's a much lower risk operation under management in practice. And Tarula then gives us a sort of stage 1 step ladder, if you will. It's a much, much easier step. But looking at Tunkillia, what do we see in that asset? Why do we like it? Why do we like big bulk open pit? And the answer, I think, as we all know, is that it is more reliably more profitable everywhere and all the time. And we look at Capricorn Metals as an example of a project that we are looking to emulate in the Australian market. So Capricorn Metals, if you're not familiar, are a $1.75 billion gold producer in Australia. In 2015, they acquired a project called Karlawinda. That was about a 600,000 ounce asset, and they grew it to 900,000 ounces in 1.1, 1.3, 1.5. And it's now about a 2.2 million ounce asset at a 0.7 gram per ton. But the key thing here is they've focused on efficient bulk open pit mining operations, where you've got an open pit and a broad mining face. We saw in the Tunkillia project many of the things that we liked in that asset. So we acquired Tunkillia. We're sort of 4 or 5 years behind them. We acquired that Tunkillia asset as about a 550,000 ounce asset. We've now grown it to 1.15 million ounces and added multiple gold zones. And we have multiple new updates pending in terms of resources over the coming few months. In parallel with just general resource growth, we've been going out and actually creating that broader pipeline. So we've actually added 4 new gold zones across those 2 projects. We've nearly doubled our gold mineralized strike over the past 24 months. We have a very strong amount of support from the South Australian government. So the South Australian government alone has given us over $1 million in grants and financing. And as I mentioned, we also monetize our assets. So whether it's leasing our camps, cleaning out our mill, doing basic workover work that we would do ourselves anyway, looking at tax R&D incentives, we're on the road to generating about $10 million in additional non-dilutive cash for our shareholders that we reinvest into this growth and project progression. And that's why today, we IPO'd 30 months ago, about 2.5 years ago. Our IPO shareholders still own 95% of our company today, not 45 or 50%. So we are well capitalized. We've been defending that. We will continue to defend that. So looking forward, it's really about continuing to scale Tunkillia, scale that middle distance, large scale platform, build up Tarula as that nice, safe, comfortable stage 1 step ladder into cash flow. And then also looking at that corporate side, continue to unlock that value. So we'll look into the assets now. Looking at Tunkillia, this, as I mentioned, is an asset we bought a couple years ago as a 550,000 ounce asset. We've grown this twice. Our latest resource update was April of this year. We grew that by about 190,000 ounces. And that cost us about $7 US per ounce on an all-in basis. So not the drilling cost, the absolute all-in cost basis. So really kind of global cost curve, bottom of that curve in terms of cost of discovery per ounce. And it's one that we think keeps growing. And we think it keeps growing because, well, we have grown the 223 deposit twice. We have 3 new gold zones that we've mapped out that we have not yet actually converted into resource. And we have multiple rigs on site currently drilling on 7 targets here. 3 extensional targets on the 223 deposit. And we're also drilling on those 3 surrounding gold zones you see there. We are also drilling a target down the shear, which we think has the potential to open the next several kilometers to mineralization. When we look at the deposit itself, that Cornerstone 223 deposit, this is where it kind of gets interesting for us. So my background is I'm not a geologist, a metallurgist, or a mining engineer. I'm a financier and an economist, and I think about things in terms of order of cash flows and how you de-risk things. So when we look at the 223 deposit, there's sort of three key characteristics that kind of come off the page when you're looking at it physically. One is has a bias to shallow. So we cut off our resources at 300 meters depth. This is for big bulk open pit. But 80% of those resources in tons are within 200 meters of surface. So a nice bias to shallow. Chiefly, importantly, there is also a central high-grade zone. So this was a thesis that we had when we acquired this deposit. We saw in the data something that looked more interesting than just a big bulk disseminated open pit. And we have confirmed there is about a 300-meter long zone there. And you can see a cross-section on the right side of the slide here. That's a cross-section through the center of the 223 deposit. For perspective, the width of the mineable mineralization there is 100 meters. So this is a football field tipped end on end of mine face. So this is big, very bulk, very efficient unit costs. And of course, mining is a little more than logistics of blasting and lifting and moving and processing. So we're going for scale here, and in the middle of this high-grade zone here, in the middle of this central zone, we've got 30 to 40 meters that have mining blocks grading 2 to 5 and 5 to 10 gram per ton. So you're going to start your high grade, you're going to start your pit on that high grade, and then you're going to open it to the north and to the south. And when we open it to the north and to the south, the third key feature here is that light blue sequence across the top. That's a supergene zone that has about 250,000 ounces in it. So as we're opening up the pit north to south to get ready for big bulk 5 million ton per annum style operations, we have that paying for us to open it. So we're not sort of pre-funding this enormous cash pre-strip before we get into operations. It's a very nice sort of schedule of development here. And everything that we've looked at here so far with Tunkillia is just in that little green box. So we're in the top sort of northwest corner of the shear. We are already stepping down that shear. We think we've identified multiple potential zones where you're potentially likely to find similar sort of multiple sequences of fluid flow, potential repeats of that style of mineralization. So we think this is truly district scale bulk open pit potential, which of course means you'd love to have some high grade material nearby. And that's where we look at Tarula. And I'll be brief here. Tarula is sort of the historical home of high grade gold mining in South Australia. This is where South Australia had its gold rush. There was also 100 years later, in the mid-2000s, a mining lease put in place where a small open pit called the Perseverance Mine was producing to our mill. And that was producing about an average of 3.8 gram per ton from a very shallow pit during 2018. That was then trucked up to our central Gawler mill. When you look at the mine itself, this is a long section of the mine. It's quite shallow. It's about 70 meters deep in its deepest point. And the historical owners were quite cash constrained, so they didn't drill beneath the pit. They didn't drill along strike. We have done that. We've identified that mineralization carries unsurprisingly down the structure up to 200 meters below the pit floor. And we've also identified a new high-grade gold zone sitting right behind the southern pit wall. So we're now going to put some more drilling in underneath the pit floor to see what we can tie together in terms of quickly and cheaply accessible resources in the immediate pit floor, but then also that sort of immediate extension of the pit. And this is interesting because it can kind of become stage one, year one with our existing mill. And so ounces here represent high value. But more importantly at Tarula, when you zoom out just a little bit, this is what these sort of subterranean features of the architecture underneath that historical gold field look like. There are 600 historical high-grade scratchings across the top of this area. It's about 15 kilometers long. We have now mapped out a series of faults and structures that are identical to the one that created that high-grade open pit. We're the first people to map these. We've actually just shot another seismic program, which we've completed in August. And what we're doing is looking to tie together this zone between this eastern bookend of the high-grade pit that we have on the mining lease and this western bookend called the Warburton Prospect, where AngloGold drilled 16 meters at 3.5 gram from surface in 1997. We think we can create a field of these high-grade open pits, which would then act both as high-grade blending feed to a big bulk operation at Tunkillia, but also then give us several years of feed to go into that stage one and self-fund ourselves through a progression of growth and development. So I'll leave it there with a couple other notes. Of course, we will continue our asset monetization. We will be looking at potentially processing some of our stockpiles next year, continuing to defend our shareholders from any potential dilution or excess dilution. And coming up, we have a lot going on. We're just wrapping up another 20,000 meters of drilling. We will expect to have another resources upgrade out in early December, and then another one out probably as early as March, before getting back into drilling again for more resource growth, both at Tunkillia and Tarula. So we think we've got a pretty compelling proposition, as it were, in the so-called explorer market. Again, it is, we think, a pretty deep value, but importantly, for us, it's really about the infrastructure, the people, the accessibility, the plan. We are making really serious progress at pace towards development operations, and happy to take any questions you may have.